Does any of that weakness in the oil price set us up for yields to drop? Because that seems to be what has really substantially changed for equities, along with the oil price over recent months. Can we hope for a lower yield environment or no?
In the very short term, at the front end of curves, if oil prices come down, the market may pare its expectations for central banks. But basically, our view to the question of could this lead to a durable rally in fixed income is no. We expect high yields. In Europe, in the US. Europe, we think it's going to be driven predominantly by supply dynamics. US, we actually think it's going to be driven predominantly by Fed hikes.
The debate in, say, Europe or in the UK has been about, well, you know, we've had this inflation shock, but actually the rest of the economy is not so strong, the labour market's not so strong, and therefore the likelihood of second-order effects is much lower. That's not the situation in the US.
On the ECB side of things, I still stand by my case that I think it's policy error, right? So they hike this week, there's a risk they're going to be cutting, towards Q4, and we've sort of been there before, right? Because if you just look at the figures, if you look at where household demand is, where aggregate demand is, completely different place than compared to where the US is, right? So that's where the new Banque de France governor, coming in, I think he's going to have a very, very, very strong message about growth.
We were coming pre-war with growth that looked more like 1.3. So there is substantial, right? And this is the damage that the conflict is doing. So we definitely are in a situation in which the ECB has to deliver a hike, but it cannot be too aggressive for this reason, for the reason of growth.
My narrative for the Fed is either they're probably on hold or they hike multiple times. Because I think if by the time they get forced into doing a hike, that means they are acknowledging they're behind the curve and they'll have to go multiple steps. So it's a little bit binary on the rates path as well.
Is it better to raise rates then? Just kind of stamp that out.
In the States?
In the States and here in Europe.
I get a sense that particularly in the States that it's going to be something that's going to have to happen, and I think it's going to go against the narrative of the presidency. The danger of not doing that is you lose control of a growing inflationary situation. You lose credibility as a sovereign power, and I think that's really important. And the institutional confidence, I think, particularly in the Treasury market, which is, on the end of a very large budget deficit, I think is important.